The IRS has issued the 2025 tax brackets. Now, each year, the IRS looks at about 60 items and adjusts those based on inflation, and that is to avoid what we call inflation bracket creep, where inflation is pushing you into a higher bracket, even though your income is not on a inflation adjusted basis, is not at that level. And so this annual adjustment is a good thing because it keeps your taxes versus income at a comparable level from year to year. Now, I want to focus on next year's tax brackets, especially because next year is the last year of the Tax Cuts and Jobs Act, unless there's some changes made. Maybe they extend it, maybe they come back and improve it, but we don't know. And so we need to be thinking about the fact that under current tax law, Tax Cuts and Jobs Act will expire at the end of next year. And so this is going to be a last year for you to do some planning under the current brackets. When I'm looking at doing tax planning with most people, we're looking at either maxing out the 22% or the 24% bracket. Those are good, decent brackets when we compare that to long term. The 22% will become 25% if Tax Cuts and Jobs Act expires, and the 24% will become 28%. And so maxing out those brackets help us, get as much at a lower tax paid currently. That could be Roth conversions. It could be, capital gains harvesting. It could be a lot of different things. So when you're looking at your tax planning, you may be focusing on 22%, you may be focusing on 24%. Let's talk about the changes in those brackets. And so I typically have this card, this handy dandy flyer for each year. Happy to share one with you if you would like one. But what this tells me is that in 2024, the top of the 22% bracket for somebody that is married filing jointly is $201,054. And in 2025, that is going to go to $206,700. That gives another $5,646 that you can use to go ahead and settle up on some taxes if that's good tax planning for you. On top of that, the standard deduction is going to increase. So for married filing jointly, it'll go from $29,200 a year to $30,000 a year. That's another $800 increase in wiggle room when you're doing your tax planning. So the total of that, if you're targeting the 22%, is another $6,446. If you're targeting the top of the 24%, that's currently $383,900, and that will be going to $394,600. And then when we add in the $800 increase in standard deduction, there's a total additional $11,500 of wiggle room next year if you're targeting the top of the 24% bracket. Now, if you're single, the numbers are smaller, and you don't have as much room overall. But if you're single, then the 22% this year is at $100,525. That's going to go to $103,350. And the standard deduction for a single filer will go from $14,600 to $15,000. So that gives you, between those two changes, an additional $3,225 of wiggle room if you are a single filer targeting the top of the 22% bracket. And if you are a single filer targeting the top of the 24% bracket, that is currently $191,950. That is going to go to $197,300. And adding in that additional little bit from the higher standard deduction, there's a total $5,750 wiggle room if you're targeting the top of the 24% bracket. So bottom line, you do have a little bit more room. I know it doesn't sound like big dollars. You may be trying to convert $1 million or $2 million or $3 million IRA, and these sound like somewhat small amounts, this additional wiggle room. But keep in mind that good tax planning is taking advantage every year of the amount that you can take advantage of, because that sets that amount up to be in a very good place long term. So if you're able to convert an extra $5,000 or $10,000 from your IRA to your Roth this year, then all the growth on that going forward is going to be in that tax-free bucket. So you want to take a look at it. Keep in mind these higher amounts of wiggle room, and keep in mind that next year may be the last year under the current lower brackets, so it's going to be a good year for you to do some good planning. Do the planning this year before end of year, and do the planning next year. So with that, happy tax planning. I hope that puts you on your best path for your retirement.